If there's one sector in India that isn't playing defensively, I must say it's the defense sector. After giving investors over 100% gains in the past year, the obvious question everyone's asking is, can the sector keep its momentum going or are we past the peak? It's a very valid question, and in today's video, we'll dive deep into where the Indian defense sector is heading, which I'll explain with some numbers, what's driving its growth and the challenges it might face, some good information on the Nifty India Defence Index, which is a passive play on the sector, and we'll see how you and I can get involved as investors. Let's begin. To say it in a sentence, India's defense sector is on the rise and showing immense growth potential. Historically dominated by government entities, the sector is undergoing rapid modernization and innovation, with India's defense production hitting a record high of 1,27,000 crores in FY24. Military hardware exports now reach over 90 countries. There are over 1,000 defense startups, yes, startups that have emerged in the past 5 years, working on everything from drones and semiconductors to surveillance systems and robotic mules. And in an absolute first, a Tata Group company is setting up a defense manufacturing line outside of India, producing armored vehicles for the Royal Moroccan Armed Forces. But what makes this growth even more exciting is the focus on self reliance, driven by both internal demand and international opportunities. At the heart of this self reliance push is the Indian government, and initiatives like Atmanirbhar Bharat are playing a crucial role in boosting indigenous defense production. Even the numbers back this up, with Indian companies targeting 3 lakh crores in domestic defense production and 50,000 crores in exports over the next 5 years. In fact, our defense budget is a clear indicator of the country's commitment, and for FY25, the budget allocation stands at over 6 lakh crores, which is a staggering 13% of the total budget and a steep rise from yesteryears, reflecting our heightened concerns around territorial security and growing geopolitical tensions. And it's not just India, there's been a surge in military expenditure across many countries as our world witnesses a doubling in the number of conflict affected countries over the last decade, which has driven many nations to ramp up their defense capabilities. In this global context, India has emerged as the fourth largest defense spender with a staggering defense expenditure of $83.6 billion as we prioritize our military preparedness in an increasingly uncertain world. In FY24 alone, India recorded a defense production value of 1,27,000 crores, marking a 16.8% increase as compared to the previous year. While 79% of this came from public sector undertakings, the 21% contribution from the private sector is a telling sign of the increasing involvement of private enterprises in driving India's defense growth, which, per a report by Nomura, is a $138 billion opportunity from now until 2032, given the escalating demand for defense equipment, technologies, and also services, offering significant upside for companies involved in this ecosystem. From an investor's perspective, this expansion is not just limited to orders and exports, but its impact has been seen in the capital markets as well. In fact, figure this. So, until about 2016, there were just a handful of listed companies in the space. But now, with over 20 companies, it opens up the possibilities of creating a defense themed index, which is what the rest of this video is all about. Okay, now let's talk about the Nifty India Defence Index, which brings all these developments together in a neat package for investors. As the name suggests, this index was created to track the performance of companies that are at the forefront of India's defense sector, as it aims to cover the entire defense value chain, including defense manufacturing, that is, companies involved in aircraft, submarine, and ship production. So that will be Hindustan Aeronautics, Mazagon Dock Shipbuilders, Cochin Shipyard, and others. Secondly, there are electronics and technology companies that produce advanced radar systems, electronic warfare technologies, and also communication systems, namely Bharat Electronics Limited, Paras Defense and Space Technologies, and Data Patterns India. And the value chain also includes the producers of critical defense materials, so companies like Mishra Dhatu Nigam Limited that produces alloys and titaniums which are essential for defense equipments. The top constituents of this index comprise of Bharat Electronics Limited with a 20% weightage, Hindustan Aeronautics with 18%, Solar Industries, which manufactures explosives and ammunitions, has a 15.8% weightage, and so on. On how these weightages are derived as a passively managed instrument, the Nifty India Defence Index follows a transparent, rules based approach with a defined universe of stocks. So there's an eligibility criteria, a min max number in terms of constituents. The weightages of each stock is based on its 6-month average free float market capitalization. No company can exceed a 20% weightage, and the index is rebalanced on a semi annual basis to reflect market dynamics. You can read more about the methodology in this PDF that I've attached in the description of this video. But as it stands, the Nifty India Defence Index includes 16 stocks, with 67% of the portfolio coming from PSUs, while private companies make up the rest of it. Presently, the Nifty India Defence Index has a healthy distribution across different market cap bands, with mid caps and small caps comprising almost 60% of the index. Okay, now let's talk numbers. And in terms of performance, the Nifty India Defence Index can best be described as every man's regret, with the fund clocking a little over 56% over the last 5 years. And if you thought that was impressive, wait until you look at its performance on a trailing 3-year and 1-year basis. Having said this, the story is a bit different though when we examine this on an yearly basis, and it's only since 2021 that defense as a sector started to grab everyone's attention. Of course, the reasons are obvious, with most defense themed companies doing extremely well in the past 3 years in terms of sales and profits, which eventually led to a jump in their valuations. And what a jump it was! With prominent companies like Hindustan Aeronautics, Mazagon Dock Shipbuilders, and Bharat Electronics, all of which were in a PE ratio band of 15 to 22 until the year 2022, are now twice as expensive as to where they were just a couple of years back. In fact, as a portfolio, the Nifty India Defence Index currently trades at a P ratio of 56.8 and a price to book multiple of 16.1. This number was even higher a few months back. The P ratio had even touched 70, and while the recent correction has brought it down to the 50s level, it still, on a standalone basis, looks to be on the expensive side. But that being said, let's not ignore the growth rates of these companies. And from what I gathered by reading or listening in to the earnings call of many of these companies, is that the management is pretty confident of at least matching their last year's sales growth and even exceeding it in many cases. Many of these companies have strong barriers to entry, regulatory protection. We see a massive improvement in their cash position. They have strong order books providing visibility of future cash flows, and as I said earlier, are seeing big jumps in revenue and profit growth. I'll say the future revenue potential is also something to consider and watch out for with many companies, and I'm just picking out HAL here as an example, since the management said in a recent earnings call, and I quote, "With the current visibility of orders, we will have our workload full for 2032, and we can consistently maintain this double-digit growth without any problem." So that's a revenue visibility of 8 years for HAL, something which every business would love to have, and is something I earnestly look for when writing my own newsletter. If you haven't checked out my newsletter, please do so, as I feature some exciting and potentially profitable investing stories such as Sami Hotel's remarkable turnaround post their IPO, BLS International's revenue surge following their acquisition in Turkey, Zaggle's impressive growth and international ambitions, Sky Gold's continued rise fueled by lower gold prices and increasing consumer demand, and of course, there's the story on Raymond Lifestyle and how its recent demerger has created a potential mispricing opportunity for contrarian investors. All this is a lot of research, a lot of reading, but it's all worth it when we see these ideas translate into real profits. If you haven't subscribed to my newsletter, then kindly do so now, and also tell your friends about it. Okay, so if you're interested in riding the defense wave, then how does one invest in it? Well, there are currently just a handful of options, but one that is on its way is the Groww Nifty India Defence ETF, which is currently in its NFO phase that closes on the 4th of October. This upcoming ETF by Groww is benchmarked against the Nifty India Defence Index, which means it aims to replicate this index in terms of its constituents, weightage, methodology, rebalancing, market cap, and everything else. This particular defense-themed exchange-traded fund by Groww is clearly designed to give investors a diversified cross-section of India's defense ecosystem in one go, which includes manufacturers, tech, logistics, and other support services. Being a passively managed instrument, the ETF's goal is to closely mirror the performance of companies included in the Nifty India Defence Index. Since ETFs are traded on the exchange, you can buy and sell them at any time during market hours, which is very convenient and can be used tactically also. ETFs generally have lower expense ratios, but yes, as a word of caution, one should take a bet on the defense sector only if you are genuinely bullish about it. It's crucial to understand the risks that come with sectoral or thematic funds like this one, and particularly when it comes to timing your entry and exit. In this context, and in my opinion, any sector or theme based fund should complement your satellite portfolio rather than forming the core of it. And given the volatility that comes with the defense sector or any sector for that matter, it's wise to limit your exposure to 5 to 10% of your overall corpus. Right, so the defense sector is a compelling investment opportunity that's backed by government initiatives, rising global demand, and the push for self reliance. And through the Groww Nifty India Defence ETF, you can gain broad exposure to this growing sector with just a single investment. Remember, the NFO is open until the 4th of October. So if you're interested, don't miss out on this limited time opportunity to invest in this ETF at the launch stage itself. You can invest directly through the Groww app or via any broker platform and get in on India's rapidly expanding military manufacturing sector. Thanks again for tuning in, and I hope this deep dive into the Nifty India Defence Index has been helpful to you. If you enjoyed this, please share it with others. Do subscribe to my newsletter, and I'll see you very soon with more insights. Until then.